Hello and good afternoon to everyone. This is another great webinar from Streams, Go Streams. This is Nak. A lot of you guys also know me since we have spoken before. Today, guys, we will be covering a few things on chart patterns and entry points. I think that everyone is very interested to hear in what's, on how to actually distinguish certain patterns, but also to find different entry levels and exit levels of their trades. We're just waiting for another 1 minute just for a few more attendees. As I see here, we do have a few already, but we'll just wait because some people might be delayed. A lot of people are at work as well. So today, as I mentioned, guys, the chart patterns that we're going to cover are 4 in total, and we'll go over them very, very soon. But apart from that, any questions you guys might have, you can always contact me directly, either through WhatsApp, either through email or phone, but also through our email address as well, webinars@gostreams.io. All right, any questions you might have after the webinar, just drop an email there, either to me or to the webinars@gostreams.io. So to kick off, guys, do try and follow us on our different channels. We do have a few now: Facebook, LinkedIn, Instagram, even Telegram. On Telegram, you can always find some of our signals from our team of analysts. I am in that team of analysts as well. We do give our views on the markets, but people that are with me are also on my WhatsApp groups. I do have a few groups too, specifically 2 groups where I do provide my insight to the markets and try and help people as best as I can. But yeah, try and get onto our pages. It would be great to see you guys. Try to like them as well, and hopefully we can move all together forward as a good company. So there are a few different technical chart patterns when you see the markets. If you look closely at different time frames, you can always find different kind of patterns in those charts and those instruments that you're looking at. So there are several chart patterns of varying complexity. We will review some of the below. The ones that we'll follow through with, the first 2 are the continuation patterns, which are triangles and flags and pennants. These are the first 2, and then we'll move on to the reversal patterns, which is the head and shoulders and the double top and bottom pattern, which I'll elaborate with examples as well. There are some slides that will make everyone's life easy to actually follow. So the slides that I have created is to save us time, so I don't sit and draw in real time some of these patterns. But if we have time, maybe we can go and check out an instrument and try and find maybe a pattern, so you guys can see in real time, how it's done. But the reason we're doing it with slides is, again, to save time. It's more effective, as I've noticed over time through doing webinars. So chart patterns, guys, form due to the emotions of traders. Now, if you guys have joined me during my previous webinars, you know that a lot has to do with demand and supply in the markets. It's what we call the market sentiment. It's one of the types of analysis which is quite difficult to read. But with using patterns helps us distinguish this sentiment, basically, that traders might have regarding certain instruments. Now, yesterday, guys, so that just to announce it as well, we did have record high levels for the Nasdaq. We had the numeric day yesterday for the US, where certain calculations for businesses came out, even government agencies. These numbers, as we saw, did help a lot the indices. The US indices were all up yesterday. We also saw gold also rise a bit as well. Gold was on a rise a lot yesterday. It did go to levels of 1874, from what I remember, 1875. And currently we're waiting to see also today on how things plan out for the US indices, since we had those record high levels. It's what we say in the markets, what goes up must come down, but do be a bit careful, because these things are not set in stone. So these patterns repeat due to the periods of greed, uptrend, and a fear downtrends. So demand and supply again, guys, you know, when there's a high demand for something, it'll uptrend. If there's a low demand for something, it'll be downtrending. These are trend continuation patterns, okay, which we're going to follow through with the first type of chart pattern reading, also known as price action movement for some people. So price action movement, again, is chart pattern reading, a very big part in analysis, a very big part in trading. And if you combine it with what we've covered through different webinars in the past, with support and resistance levels, trend lines, it works quite well. I wouldn't say that you'll have 100% accuracy with your trades, but I can say that it increases your probabilities of around maybe 70%, 60% to be accurate with your trade. And the reason that we always have that that small percentage that it might go against us is because, again, it is the markets. The markets can be unpredictable, but with the right type of analysis, you can reduce the amount of uncertainty. Now, during periods of indecision, other patterns form that signal reversals, basically, like the head and shoulders pattern and the double top and the double bottom patterns, which again, we will cover those with examples. A pattern must be identifiable and measurable. This is a rule when we're looking in the markets. And the pros and cons to chart pattern reading is that many patterns take time to form, giving a trader the opportunity to observe and recognize the pattern. Patterns provide entries and exits with defined risk. So as what I was mentioning to you guys, also it helps with entry points, these chart patterns. The good thing with chart patterns is that usually it can be a good thing, but also a bad thing, because you have to sit around and waiting. But patience is a virtue, as we say, and especially when it comes to trading, being patient and disciplined can actually pay you off much more than just doing your analysis, a simple type of analysis. Now, the cons to chart pattern reading is that it can and do fail. Trend continuation patterns that appear late in the trend will most likely be the pattern that fails. So it's what I was mentioning to you guys as well, that we see, say, for example, an uptrend. What goes up must come down. You know, as you can see, you know, through the examples that we'll go through, is that sometimes you might think something might be continuing upwards, and as you think it's going to continue upwards, it just drops like a rock, like out of nowhere. This, you know, sometimes is why I tell people, even if you're in front of your monitor trading, even if you're on your phone and you're looking at the trade, always implement your stop loss level. And take profit is not so much of a concern. The reason why we're entering our stop loss is what I said to you guys before so many times. You shouldn't be thinking on how much you can make during the day or during the hour. What you should have in the back of your minds is, how do I minimize my risk? And one way to minimize your risk is with your stop loss, especially when you're having continuation patterns. So moving on to our first example of chart patterns, continuation ascending triangle, okay, which as I mentioned to you, that it's so important. With me a moment here, guys, because I seem to have the systems on. Okay, so as I was mentioning, guys, continuation ascending triangle. This is what we covered before in different webinars with support and resistance levels and trend lines. If you guys haven't seen the webinars from before, let me know and I can always send them to you. It'll make your life easier to follow also this webinar. This chart that we're looking at has something of a triangle shape, as you guys can see. Okay, one is a support level. Okay, it's first a resistance level that then becomes a support level. Okay, so the line at the bottom is the trend line. It's an upward trend line, as we can see. We need to always connect the lows, basically, as we can see, of those highs. We can connect them. We can create our nice trend line here. So when having a support level, when you draw your resistance level, my apologies, as you can see, this is first a resistance level, you draw it, it becomes a support level after when it breaks. So here we can see that it has broken. And as we've seen that it broke here, it started coming down again, touched that support level, bounced off it and started moving upwards. This is a good indication right over here on the second arrow here, not the first arrow, the second arrow is a good indication of taking a buy position, going long, as we say, because we know that it's uptrending. We have our resistance level that has become a support level. It came down, touched the support, and shot back up like it's supposed to, because it has been trending upwards even from before. So you guys need to draw your support and resistance levels. It's essential. Why? For this reason here, and to combine it with a trend line. Okay, you can see a formation of something of a triangle here. This is our triangle right over here. You can see from the support level, which was before a resistance level, and connecting it to the trend line over here, where we can see here this at the edge of where again the support level crosses the trend line. It's something of a breakthrough. Here we don't see the instrument, we don't see the candlesticks going down to down here where there's a breakthrough. But usually during a breakthrough, it is a crucial time for whatever you're looking at. When the support line meets the trend line and you have a candlestick on it, be a bit careful, because there might be something happening there. It's what we call a breakout, basically, again. And moving on to a descending triangle, which is similar to what we just saw with an ascending triangle. Again, you have that downward trend descending. A descending triangle is a bearish chart pattern, as we can see here from the example. So you draw your trend line. Once you draw your trend line, you can also draw your support level here. You can see that it's touched a few points. We have 1 point over here, 2 points, 3 points, which confirms that it's a strong support level. And over here, we can see that it breaks. Right here where it breaks, we see that, again, it started moving up. Try to test it. This support line becomes into a resistance level. So one trend line that connects a series of lower highs, and the second horizontal trend line that connects a series of lows. So we can see here that the trend line connects the lows, basically the bearish candlesticks, as we can all see. Once you have also your resistance level that becomes into a support level, here it started trying to move up again, touched again that resistance level. Once touching the resistance level, it shot back down again, as it's supposed to. And even here, you can see it started rising, near again to that resistance level, okay, that we've drawn from before. Also on the trend line, as we can see, if you can drag your trend line further down, that would have been a good time to also take another sell position, or to go short, as we say. So entry opportunities on breakout or retracement. A retracement, guys, as I mentioned to you guys before, is basically a small move in the opposite direction. A reversal is a big move against the direction it's going, against the trend. So here we can see a small retracement, moving back up again, touches the resistance, and boom, shoots back down again. So very easy, the concept of the triangle, but you need to know on how to implement your support and resistance levels and your trend lines. I do suggest everyone that doesn't have too much experience to be practicing this a lot, and to go back to my webinars on how to actually draw these trend line and support levels. They will make a world of a difference, as I mentioned to you guys in other webinars. So moving on to the bull flag continuation pattern. This pattern, again, is a continuation on how things should be moving. Again, you can draw your trend line if you'd like. Here we see an ascending upward move for the instrument, a very fast moving move upwards, as you can see. The sharp move here from here is basically the flag pole, as we call it. And then you have two parallel lines from the flag, but do see how they do turn down. Now these two lines that I've drawn here, you can see the two parallel lines are in a downward direction. Okay, this is giving a good indication that it should move up again, that it's going to shoot up again, and it's a sharp continuation. Now, usually the distance from the flagpole, okay, signifies that the same amount of distance can be for the fast continuation upwards after the descent. after we see this small descent. You can see how it looks like a flag, guys, and you have the flag pole at the bottom here. This flag pole at the bottom signifies the move that will appear again upwards. So it's a very nice way to trade with the continuation bull flag, as we call it. It's not too difficult to implement, but you need to be a bit careful and you need to be a bit patient. And you can try all of these patterns on different time frames. They usually work on different time frames, but they usually work better on longer time frames. We also have now a bear flag, continuation bear flag, which again is the same concept. We draw a flag. Again, you have your flag pole in an inverse direction, the other direction now. You can see the flag pole standing up, and you have the flag at the bottom here, which is basically upside down, an upside down flag. Again, the distance that you see from the flagpole does signify that there could be the sharp continuation distance, the same amount of pips, and even more sometimes. In this case, you can see it here. The continuation was even more than the flagpole itself. So this would have been a good position to take a sell. Even if you guys entered a bit late your sell position, you still would have made a really good return, as we can see the sharp continuation move did continue quite further down. Going on now to continuation bull pennants, okay, which is again the flagpole theory. The only difference is now you see the parallel lines over here that they form into a triangle. Now, over here we see that they're moving downwards together, okay, and then we see the sharp move that comes down. This is a descending flagpole. Over here, you see the parallel lines that are closing. Now, usually when you have the parallel lines closing, okay, the narrower they get, the more closer you get to that continuation of how things should be moving upwards in this case. Okay, the triangle formation that forms the pennant is this small place here. You can even use it in a 1 minute chart. You need to be a bit more careful though with a 1 minute. You can use it in a 5 minute, 15 minute, all the time frames. And when you have the two parallel lines closing in, the closer they are to each other, the closer you're getting to that move that could actually be the situation where it might start jumping up again. Moving on to a continuation bear pennant. Okay, it's the same thing as what we saw from our previous slide. It's just an inverse way. You have a flag that's upside down. Okay, you still have the flagpole here, and over here you have the parallel lines that are closing in. Now remember, the closer they're getting to each other, especially when they cross, if they cross, then that's a good signal that you should take your position, good entry level. So you see, guys, this is what I was talking about, entry levels and exit levels. Here during this scenario, your exit level would be determined from the next, in this scenario, support line. So it's good to draw your support and resistance levels again. The support level in this chart that we're looking at, this description of what we're looking at, would be your next target to actually try and hit. Of course, if you see that it can hit that support level fast, the first level that you have, then you can always extend that support level to the next level, so you can take more profits. So just remember, guys, that as these parallel lines close in, try and draw them. Usually the closer they get to each other, the closer you're getting out to the breakout, basically, of a continuation downwards. And you can see the flagpole amount of pips here is the same distance as the sharp continuation here, nearly the same. Sometimes it might not be, sometimes it might be a bit less, or it might be even more, as you guys can see. So we're going now to see the reversal patterns, which are great also for trading. A lot of people wait to see the reversal. They prefer trading on reversals. I can tell you a lot of experienced traders prefer it, and it usually works for them better than rather than continuation. Continuation patterns are good when you're trading, for example, some kind of big event, some kind of news, some kind of fundamental that affects the market, like yesterday's NASDAQ that we saw, using a continuation pattern would be amazing, because we saw a few flags develop, but this was usually on the shorter time frames. In the longer time frames, it would have been difficult to see those flag poles that were created for the upward move that we saw for the indices yesterday. But with what I'm mentioning with the reversals, again, a lot of people prefer it. They do well with them, and it works for a lot of people, the reversal trends. So moving on now to understand that the head and shoulders, as we call it. Now you guys can see here a pattern that is something like which is actually a head and shoulders. You can see your left shoulder right over here. You can see your head, and then you see the right shoulder, okay, which is exactly a formation of a head and shoulder pattern. Now you need to also again try and draw your support levels. Here this was drawn after the first shoulder touched one level, and then you have the neckline. This is called the neckline touch again. This 2 points here helps you create your support level. So these 2 points that create your support level gives you a good indication of the neckline. This neckline usually is broken on the second shoulder, on the right shoulder, as you can see here. So usually the distance from the head to the shoulder, all right, is an indication that it should move in the same amount of pips downwards after you break the support level. Okay, so here we have it. Okay, see the graphic designer of Streams did a good job in adding this as well. So again, you have your head, okay, you have your first shoulder, your left shoulder, you have your right shoulder, you have your neckline. This point here, the second point here, creates the neckline, which helps you draw your support level. Once you've drawn your support level, you need to wait for the second shoulder to start forming. Once you see it start forming, this is your second shoulder here. You should be getting ready to take a sell, but you shouldn't be in a rush either to take your sell position. You should actually wait just a while until you reach that support line, which is down here. And usually the difference that you take from your head to the neckline is the difference that represents the first target. So your first target to reach, okay, should be somewhere around here with the continuation patterns. Okay, sometimes it might be a bit different as well, but again, continuation patterns and also the head and shoulder patterns, even if you have your first support level target to reach, that could also be your take profit level. But usually it's the same distance moving downwards that you'll have from your head to your neck. Should be somewhere around those levels. So moving on to a reversal double top. Okay, this is as well one of my favorites. I do like to trade on the double tops. I also like the double bottoms. So you usually have an instrument that is testing a certain level. This can also be considered a resistance level. Okay, you have the two high points as we can see them here. Okay, it tested it once, came a bit down, went up again, tested it a second time, and you have again your support level here. And as you can see, it looks like an M. Okay, so what we're looking at looks like an M shape. And once breaking that support level over here where your midpoint is of your double tops, once it breaks it, usually the target pips to follow on a sell should be roughly about the same as your high level to the support level. Usually it's the same amount of points again. So your entry level should be somewhere on the line, on the support level to take your sell. If you do take it even from before, well done on you if you do, because you'll obviously make more, you'll gather more pips through your sell position. So measuring from high of one top to the pivot low, okay, this is the pivot low here, the average. Okay, as we can see, these two tops have met, okay, which again, you can also draw a resistance level on these two tops, all right, because it's 2 points, it's a level, but it's not a very strong level. Usually a strong level is represented by 3 points, usually. This is what we say in the markets, that if you have 3 points, it's a more confirmation for basically that level. So again, as I mentioned, you see the double tops from the where it is until the pivot of it, okay, where the support line is, creating that M should be your entry level for your trade. This is the orthodox way of trading, but again, even if you're able to take it from before, sure, you do take a bit of a risk, okay, if you do take it before breaking the support line here. But again, with that risk, you can gain much more. With more risk, you gain more reward. Obviously, it goes hand in hand. Now we have here an inverted way of seeing things, a reversal double bottom, as we see it. Okay, double bottom, where you have the two low levels here. Okay, you can see that it first came down 1 point here, try to go back up again, and on the second point, which again you can draw your support level. Okay, try to move back up again, and it did, and it broke through it. So your level basically from the lowest point until the midpoint over here, even from before maybe over here, the pivot here, could actually be the same amount of target pips that you guys need to reach. You can always calculate this as well through the MT4 chart by using the cross function on your MT4 chart. Using your cross function to measure the amount of pips does give you a better understanding on what you're able to gain through that trade. So that was basically a few things on the patterns, guys. I hope that it did help you to understand a few patterns. There's 4 that we did today. Continuation triangle pattern, the flagpole, which again is a continuation pattern, and the reversal patterns, head and shoulders, and the double tops and the double bottom pattern, which again, this webinar will be recorded so you guys can view. Going really fast to candlestick translation. Usually when you see a candlestick that has no shadows or wicks, as we call them, no lines, for those who don't understand what a wick is, usually this is where we see that one direction is in control. If you see an upward or a bull candle that has no shadows, we usually say that the bulls are in control, and there's a higher probability of it continuing up. Again, if you see the shadows have no wicks, if you see the candlestick has no wicks and it's just a plain body, this bearish candlestick represents that the bears are in control and there's a higher probability of it moving downwards. Now remember, I say probability because it's not set in stone that of course it'll go down, but there's, I could say, a much greater possibility that when you see just the body of a specific candlestick, it should be continuing in that direction. Now a doji, okay, this is basically a candlestick where there's no body. Okay, on the MT4 chart, when you're trading the streams, you'll probably see a few dojis on the 1 minute on the lower time frames. You can also find them on the higher time frames, but overall, you usually find them on shorter time frames. I mean, this is how it is on shorter time frames. Things move faster, and you can see, you can see more candlesticks obviously in a shorter time frame. So dojis appear mostly on the shorter time frames, and this is usually signifying that the bulls and the bears is an even fight or an equal fight between the buyers and sellers, basically. No clear direction. And usually when there's a doji, you need to be very careful. Some people say that when there's a doji, it's very unpredictable, but it can also work to your advantage, the doji, with, if you have, for example, a key trend line. So if you draw your trend line and there's a doji, you could expect some kind of a reversal. If you have a channel line is basically having an up and down trend line, an upward and downward trend line, which does create some kind of a channel. It's also called a tunnel in the terminology. Again, if you have a doji on a support or resistance level, again, this is a potential for a reversal. Okay, again on a Fibonacci line, Fibonacci retracement levels, which are again like support and resistance levels, which we will also cover Fibonacci levels in one of our webinars. Again, do remember, when you have a doji, when you have something like a cross like this on either your trend line or your channel line or your support and resistance level, you should be ready for some kind of reversal, and it's usually a big reversal. So these are usually on the shorter time frames. You can also find them on longer time frames. Moving on to different candlesticks on how they present themselves, guys. Okay, we have so many different types of candlesticks. These are just a few of the basic ones. We have what we call a spinning top here. Okay, sorry, let's start off with the top one here. Selling pressure is usually the wick that's on top. Okay, the bigger your wick is, the longer your wick is here, or shadow as we call it, then there's more selling pressure. Here, the bottom wick or shadow, the longer it is, the more buying pressure there is. So there's more favoritism in taking a buy when you have a longer wick. Now, a spinning top is similar to a doji. It is quite risky. It's the even fight, as we say, between the buyers and sellers. Mixed emotions by people not sure on what to do, on either to buy or sell. Okay, with a spinning top, you guys need to wait. It's the best thing to do instead of taking a trade on a spinning top candlestick, because with the spinning top, there's no real indication on whether or not it's going to continue upwards or downwards, or if there's going to be a reversal. With the doji, it's a bit different. The doji, at least if you're on a support level, if you're on a resistance level or a trend line, you should expect some kind of a reversal when you're with the doji. Okay, the high wave, again, similar to what we were talking about with the spinning top, but usually you have the shadows that are much longer. Usually having longer shadows means that there's a lot of volatility. So the longer your shadow is, okay, the more volatility there is, the more uncertainty there is. Spinning top, usually your lines, your shadows will be, small to normal levels, like the body of the candles, the body of the candlestick. Whereas a high wave, the shadows are usually longer than the body. This is again an indication to be a bit careful at the moment, because it's uncertain and there'll be a lot of fluctuations to it. Moving on to the hammer here. So usually when you have something descending, you have an instrument moving downwards. So you see a hammer candlestick. As you can see, you have the body on top with a shadow at the bottom, which looks like a hammer. You should expect some kind of reversal upwards. Okay, so you have it moving downwards, downwards. Then you have the hammer created candlestick. And as you can see, this is buying pressure, guys. Remember what we said, buying pressure over here. Here, this is for selling pressure. So if you have something that was going upwards, shooting up on the shooting stars, we say, shooting up, it reaches the peak. You usually have a shadow that is long on top like this, and the body that is smaller. This is what we call the shooting star, because it will go and feature like a shooting star, basically. So something that is going upwards, upwards, reaches the top, will then start descending. This is the candlestick that will give you the indication that something will reverse and start going downwards. This one, the hammer, is something that is going downwards, will start to move upwards. Okay, try to remember these, guys. If you don't, you can always go back to the webinar and view it. And the hanging man, instead of having a red candlestick here, so you have something that is again ascending, the moving upwards. Again, it's also called the hanging man. Shooting star and the hanging man are very, very similar. It's just the difference is one is a bull and one is a bear candlestick. Usually the bear candlestick, the shooting star, it's a bit more of a reliable reversal than the hanging man, but the hanging man also comes through most of the times. So guys, I hope that you enjoyed this webinar. I hope this was very informative and made sense to you guys. It would be good to come back to me with any questions you guys might have. Again, to leave questions for me for this webinar is at webinars@ghoststreams.io, or just come directly to me through WhatsApp or through emails, and I'll elaborate on whatever we've covered. So thanks, guys, for joining me, and do join us on Facebook and Instagram. Don't forget. Thanks for viewing. Cheers. Have a great one.